Hello, my name is Emily Becker. I'm president of Orleans Capital Management, and I'm pleased to present to you today an educational presentation on the fundamentals of fixed income. The goal for today's presentation is to give you an overview of bonds, how they perform in the context of a portfolio allocation, and then I'd like to finish with some current market commentary. I'd like to start today by talking about why we own fixed income. What is its relevance in an overall portfolio allocation? First thing I would say is that fixed income is and should be your most stable asset class. This is typically not the asset class that we're looking to provide the highest returns. We're not swinging for the fences in terms of performance, but we're looking for stability in terms of the principal preservation. And in addition to that, it also provides regular and predictable cash flows, which you can use to fund your liabilities or provide for your other cash needs. In addition to being the most stable asset class, this allows you the freedom to invest more confidently in the riskier asset classes. And because your preservation of principal is there, in addition to receiving income off the portfolio, you should feel much more comfortable going for the fences in equities, real estate, hedge funds, and those riskier asset classes with the comfort of having an anchor of your portfolio such as fixed income. Fixed income also provides liquidity in times of volatility, which we saw most recently in the first quarter due to the dislocation of markets during the pandemic. So those funds that needed income and cash flow to fund certain obligations that they had were able to do that with the fixed income without having to disturb their other asset classes that may have seen precipitous drops in price return. In considering the relevance of a fixed income investment, it's important to look at it in the context of total portfolio allocation. I've mentioned the importance of principal preservation as well as the cash flow that comes from bonds, but I'd like to take a historical look at long-term bond returns. While equities over time typically provide the highest returns in your portfolio, bonds have actually been a pretty steady performer as well. And what you see here is a chart of cumulative returns over the last 20 years. So using these Vanguard ETFs as a proxy for the respective asset classes, at some point in 2001, you saw that the bond fund actually moved ahead of the S&P and continued to outperform. In addition to that, the bond investments provided a steady return and an income stream with lower volatility. So what type of investments are included? What is the universe of fixed income securities that we're going to be talking about today? We're going to be strictly sticking to domestic fixed income sectors. I'm not going to be talking about foreign bonds or sovereigns or emerging markets. But in the domestic fixed income universe, the types of securities that I'll be covering today are U.S. Treasuries, U.S. government agencies, corporate bonds, municipal bonds, and mortgage-backed securities. So before I go into the specific securities that I mentioned, I'd like to talk about relative to other asset classes, how do bonds work? I'd like to start by talking about total return. There are essentially two types of total return. The first component of that is income return. Income return is really a cash payment. It's money that you get to keep that you put in the bank. That can come in the form of a coupon payment on a bond, a dividend payment for a stock, or a rent payment on a real estate investment. For fixed income, that coupon payment or that cash payment is a contractual agreement. It's interest that's usually paid monthly or sometimes semi-annually. And for equities, that cash payment usually comes in the form of a dividend. That's not contractual and actually can be changed based on company fundamentals and profitability. So for example, stocks doing well might increase their dividend payment to their shareholders, or if times are tough, the company's profitability has decreased, then they can also cut their dividend. So that's something that can move, whereas in fixed income, it's going to be the same amount because it's contractual. The other component of total return is price return, and price return is really based on what someone else will pay you for that share in the future. So the important distinction here is that income return is founded upon the existence of a contract in fixed income, and price return is reliant on future investor sentiment. So if we know that income is steady and contractual, then how should we look at price return for bonds? What is the effect of changes in interest rate on bond prices? So if we have an environment where interest rates are falling, then we can see here that if interest rates fall, bond prices increase. Why do we have an inverse relationship there between bond prices and interest rates? Well, if you think about it this way, when interest rates fall, your current bond that may pay a 6% coupon rate is now worth more in a lower rate environment. So if interest rates were to go down to say 4%, your 6% coupon rate is worth more, so therefore your bond price goes up. The exact opposite is true in a rising rate scenario. So in an environment of rising rates, if interest rates go up, then inevitably bond prices will go down or decline. And the reason for this, again, is that when interest rates rise, your now lower coupon, say your 4% coupon, is worth less when you can go out in the higher interest rate environment and buy, say, a 6% yield. Changes in interest rates directly impact bond prices. However, if you don't sell your bond before maturity, then your price fluctuations are essentially meaningless. Because at maturity, you will receive all of your principal back in full. In speaking about price movement, let's talk about investment horizons. What's important for investment horizons is the significance of time. As we mentioned in the last two slides, we talked about the inverse relationship of interest rates and price movement. However, price movement is short-term and it's temporary. In order to capture price return, you would need to sell your bond before its maturity. So if interest rates were to come down and your bond were to appreciate in price, you could sell it and capture some price return. However, you now have to take your proceeds and reinvest those in a lower interest rate environment. In looking at the intermediate time frame, income becomes more important than price return. Over the life of a bond, you're collecting your coupons and you'll collect the principal at the maturity of your bond as well. In the long term, as you capture the principal and the income off of a portfolio of bonds, these funds are then reinvested in the marketplace. And over the longer term investment horizon, reinvestment rate becomes the largest and most important component of total return. So one question you might ask is, why not focus on capturing price return? We believe that capturing price return is really kind of a trading strategy and is typically not effective in the context of managing a bond portfolio. And the reason for that is it's pretty difficult to predict interest rate movements. We don't believe anyone has the gift of prophecy, and interest rate and therefore price changes, they can occur slowly over long periods of time, or they can happen suddenly and sharply with a great magnitude in the course of a few days. And what we've shown you here is a graph of the 10-year U.S. Treasury over the last 5 years. And you can see there's been quite a bit of volatility in the yield of that bond. So the question becomes, when you're looking at capturing price return, where do you buy, or when do you buy, and when do you sell? If you buy and then you sell, you have to then decide when to get back in the market. So you're having to make several decisions to capture price return, and you have to be right about that call time after time after time. And we feel that that's a very difficult thing to do, and it's not, again, highly effective in the context of managing a bond portfolio. Going back to the types of securities that are included in the fixed income universe, I'd like to cover some specifics about the types of securities, what their benefits are, what are their risks, how do they behave, and how they might fit into a fixed income portfolio. So I'll start with government securities, and specifically U.S. Treasuries. U.S. Treasuries are the direct obligation of the U.S. government, and they cover a time horizon. You can buy a maturity that's 1 month, a 3-month Treasury bill, all the way up to a 30-year Treasury bond. They're considered the highest quality, AAA rated, and the lowest credit risk. And because they're so low in their credit risk and so stable, they also offer the lowest yields over time. So they're not providing a lot of yield for the portfolio, but they do provide a lot of stability and a high credit profile. Also included in the government securities are U.S. agencies. So those are the obligation of governmental agencies such as Fannie Mae, Freddie Mac, Farm Credit, and Home Loan. These are also very high quality bonds. They have a high credit rating of AA, which implies the guarantee of the U.S. government, and they have marginally higher yields versus treasuries. What are the benefits and risks of owning government securities? Starting with treasuries, treasuries tend to be the most sensitive to any changes in interest rates. They typically offer low returns relative to other asset classes, but they are historically lower volatility than not only equities but also other bonds. U.S. agencies are the next most sensitive to changes in interest rates. Although they can be slightly more volatile, they also have a somewhat higher credit risk, but still very, very low. Usually, treasuries and agencies perform best when there's a flight to quality. When there's some event going on in the market that causes people concerned, they tend to move into and buy treasuries and agencies. But the largest risk really is the opportunity cost of owning the lower yield and not owning something higher in yield that you never get to recapture that income and the yield in the portfolio. The next category is corporate bonds. Corporate bonds are the obligation of a corporation issuing debt. Essentially, you, the investor, are loaning the company money. The credit rating is based on the company's ability to repay that debt, and the yields vary in correlation with the company's credit worthiness. They're priced in terms of spreads, which is actually the basis points in yield versus a comparable maturity treasury bond. The wider the spread, the lower the price and higher the yield. The narrow spread means a higher price and a lower yield. Interest on corporate bonds is paid semi-annually. Municipal bonds are similar in that they are debt, however, they're issued by state and local governments. And the loan, or the funds, typically fund public works such as parks, libraries, infrastructure like bridges and roads, and other types of infrastructures. The interest paid on municipal bonds is often tax-free, although we'll also talk about taxable municipal bonds. That's a growing market. The credit rating of those bonds are assigned or based upon the issuer, which is the municipalities, their ability to repay the debt. Again, the yields vary in correlation to the municipality's creditworthiness. The interest is paid semi-annually. The one unique thing about municipal bonds is that they can be refunded or paid off ahead of their final maturity. Within municipal bonds, there are actually two types of municipal bonds. The first is general obligation, or GOs. GOs are secured by the full faith and credit of the issuer, such as a state or a city, and the funds that are used to repay those come from general revenue funds of that municipality. There's also revenue municipal bonds. They're secured by a specific future stream of income, such as a utility or payments from customers or tenants, such as water and sewage revenues, arenas, toll roads, particular project. They're also secured by sales, fuel, hotel occupancy, and other types of taxes. In looking at the risk with respect to both corporate and municipal bonds, there are companies such as S&P and Moody's who rate the creditworthiness of these institutions or these corporations. And you can see here that we divided it into both investment grade and high yield or non-investment grade categories. So what do these different ratings that are assigned to these companies or municipalities mean? A AAA rating is the highest rating, so its capacity to repay principal and interest is extremely strong. So very, very high quality. Again, U.S. Treasuries fall into the AAA. Microsoft falls into AAA category. A AA rated bond is also very strong. It differs from the highest rated bonds in only a small degree. So for example, a U.S. agency like a Fannie Mae or Freddie Mac is a AA. A company like Amazon is a AA. Single A rated bonds are also very strong. They're judged to be slightly more susceptible to adverse economic conditions. And then in the lowest ranking of investment grade security would be BBB. It's investment grade and it has the adequate capacity to repay interest and principal, but there's certainly some uncertainty there. When you move to the high yield or junk bond arena, Standard & Poor's has the top rating in junk is BB, meaning that it's predominantly speculative or subordinate to BBB securities. Single B is a company or a municipality that has greater vulnerability to default. It currently has the capacity to meet the obligations, but may not be the case in the future. Anything in the C rating, CCC, CC, or C is currently identifiable as having a vulnerability to default, and a bond that has a D rating is in default of payment of interest and/or principal is currently in arrears. So when you take on credit risk, the lower the credit quality, the higher you would expect to be paid in terms of yield, and that's definitely the case. And what we show here on page 16 is a chart across the different maturity spectrum from 6 months out to 30 years. You can see or identify the yields that are available in these different categories that I've just mentioned. So the lowest one, the kind of pink line there, you can see that that's U.S. Treasuries. As you mentioned, they have the lowest yield. And then you can move up to see the purple line, which is the U.S. agency curve. So I mentioned they're only slightly lower in rating than Treasuries. And so they have a slightly higher yield across the maturity spectrum than do Treasuries. But you can look at corporate bonds and you can look at taxable municipal bonds, and you can see by the blue and the yellow line, you're paid substantially more in terms of yield versus a U.S. government or agency bond. And that's what we focus on doing when we're trying to build yield and capture as much income and as much yield as possible for our portfolio. We look to taxable municipal bonds and corporate bonds to provide that element of yield into the portfolio. The final category I'd like to talk about is mortgage-backed securities. And for the purposes of the presentation today, I'm just going to be talking about government mortgage-backed securities. So these are the securities that are backed by those U.S. government agencies I mentioned earlier, Fannie Mae, Freddie Mac, and in this case, Ginnie Mae as well. While they're backed by the U.S. government, these are bonds that are secured by pools of single-family home mortgage loans. So think about your own home mortgage loan. When a collection of similar home loans are packaged together, they form the collateral of the bonds that secure the bonds that investors are purchasing. One of the differences in mortgage-backed securities is that not only do you have this contractual interest payment coming in, the payment of interest comes monthly, and you also receive principal monthly. So if you think about your own home mortgage, every month you're paying interest and principal for your mortgage. That is passed through to the investor, and that's one of the reasons that they're called pass-through securities. These bonds generally pay off ahead of their stated final maturity. They're offered typically in a 15-year package or a 30-year package, just like home loans are for mortgages. But they do pay off ahead of time, and that's affected by refinancing trends and loan payoffs. So for example, if you were to move and pay off your house so that you can move, all of that principal that comes back from that mortgage loan is then passed back through to the investor, where they're getting their principal back early. There's also other types of mortgage-backed securities that we call derivatives. Those are collateralized mortgage obligations, CLOs, which are collateralized loan obligations, CMBS, and there's also non-agency mortgage-backed securities. Those exist in the context of the benchmark that we typically are compared to, but I'm not going to go into those highly structured and esoteric products today because they're actually very complex in their nature. The risks associated with mortgage-backed securities. But they're really not a credit risk. Again, they're backed by the U.S. government agencies. They're secured by high-quality loans, home loans. The risk of investing in mortgage-backed securities is primarily the risk of the prepayment of those principal and loans. So when you have a falling rate environment, prepayments speed up. If you think about the falling rate environment in the context of your own home loan, if rates are at 5 and they go to 4%, you would decide potentially to refinance your own home loan at 4%. So all of that principal from people's homes being refinanced is coming back earlier with it to investors. What's happening is they're receiving that principal, but now with the lower interest rate environment, they're forced to reinvest now those funds at lower rates. And the opposite true is if rates rise. If rates rise, people don't refinance their houses. They may not buy new houses, so prepayments slow down. So now you're receiving less principal to reinvest at the new, higher, more attractive rates. When you'd like to be able to do that, that's when you're not getting your money back. If rates stay pretty steady and pretty much the same, then prepayments consistently pay, and you receive a predictable flow of principal at the current rates, and that's really the best case for return with respect to performance of mortgage-backed securities. Something that's become very topical these days is the idea of buying ETFs and indexing. And as opposed to active management, it's definitely a strategy, and a lot of people employ passive management both in the equity markets and the fixed income markets today. both offer liquidity for certain. Both do incur a cost. I think people are under the impression that a passive investment doesn't cost anything. There is a small fee differential between passive and active. Active, you pay slightly more in terms of fees, but it's not free. It does incur a cost. One of the problems with indexes and index funds is that the good news is you do get index-like return. Those are very reliable, but there's really no way to win. You get the index, kind of warts and all. Owning the index means owning everything in it, which means you can't discriminate against underperforming sectors, you can't discriminate against industry groups, and you can't discriminate against problem credits. That's certainly been a problem when you had periods of time in 2002, 2003, when you had a lot of defaults like WorldCom and Xerox and those types of credits that defaulted. You owned them because they were in the benchmark. Additionally, the Great Financial Crisis, you had a lot of high quality bonds, Bear Stearns, some of these financial companies that were AA rated that defaulted. So by not having active management, you do get index-like returns, but you don't have the ability to avoid problem credits, which can be pretty devastating. Unlike a stock, when a stock price goes down, usually there's some recovery or rebound. When a bond defaults, there's no recovery. It goes essentially to zero. You also don't have the ability to move among sectors to enhance yield and return. So you get the allocation that is the index. So if that's 40% treasuries and 20% corporates and 30% mortgage-backed securities, you are limited in owning those specific allocation of those sectors within the benchmark, whereas an active manager can move within those sectors to enhance the yield and return on the portfolio. The other thing that's interesting is in a period of, you rather have an active manager in a rising rate environment. We haven't seen that for a long time. I don't think we're going to see it in the near term, but we do have the potential for negative rates. We are in a very unusual environment with respect to global interest rates and the economies. So the potential for negative rates would also present a concern for indexing and owning ETFs. But over the long term, indexing historically underperforms active management. It's available, and again, you do get the index return, but you don't have really the opportunity to win. So now I'd like to talk a little bit more about the investment environment that we're in and our market outlook for the near term. I'd like to start by talking about relative value among sectors and corporate bonds, how they have performed recently, and the unrelenting demand for corporate bonds. We've been in a low interest rate environment for quite a while. Actually, for the last 10 years or so, we've been in a historically low interest rate environment. And the chart at the top left shows some of these significant market events or bear market events that have occurred over the last 25 years. You can see the dot-com bubble, you can see the GFC, which was the Great Financial Crisis in 2008, energy downgrades that occurred at the end of 2015, and now COVID. And what this is a chart of corporate bond spreads, and as I mentioned, as corporate bond spreads widen out, their prices decline. But after each of these bear market events, what you do see is pretty quickly those bond spreads move back in and they tighten up and those prices increase and they return back to where they were or better. And we've actually seen a pretty healthy recovery in corporate spreads post-COVID that occurred in the last quarter. But we're continuing to see unprecedented demand for both new issue and secondary market bonds. They're driving prices higher because everybody is looking for yield. In this low rate environment, investors, and that includes pension funds, insurance companies, individuals, everybody's looking for yield. And every basis point of yield counts. In a low rate environment, that's pretty difficult to achieve. But you can achieve it in the corporate bond area. And you can see here, as we showed the graph in a few slides back, the yellow line is the U.S. Treasury curve, where you're getting now, in today's world, less than 1% on anything out to 10 years. And on a single A corporate, you can get around 1%. And on triple B corporate, you can maybe get up to 2% yield. Every investor is looking for that yield. So on a percentage basis, on a 10-year bond, you can get 60 basis points or 60.60% yield on a treasury, or you can go get over 2% on a corporate bond. A lot of people want to own those corporates. The chart on the upper right shows the amount of new issuance of corporate bonds. And you can see that in 2020, with very, very low rates, a lot of companies have gone out into the bond market to raise money because the interest rates are so low. And we've had over $1 trillion of new issue of corporate bonds. All of that has been eaten up by the global demand of investors around the world. In fact, some of the new issues that came out early in this year were 5, 7, 10 times oversubscribed, with everybody demanding yield. And additionally, the positively sloped yield curve presents an opportunity to add yield across the maturity spectrum. So as long as you're willing to not only go lower in credit quality, the further you go out in terms of maturity, you can also capture yield there as well. Another macroeconomic consideration is the mounting debt that we have in our country, as well as GDP. As I mentioned, interest rates have been and will continue to remain low for at least the foreseeable future. We've also had a lot of fiscal stimulus and a lot of monetary policy which has been put into the marketplace in the last quarter to help overcome the unemployment and the difficulties that have occurred in the COVID crisis. Those did all help ease liquidity in the marketplace. They boosted asset prices, but what we don't know is at what cost. What's going to happen in the future as a result of all of this stimulus and all of this money coming into the market. It's propping up the market now, but what are the long-term implications? I think there's some speculation that it won't necessarily lead to an inflationary environment, but a deflationary environment, which would be pretty difficult. The overuse of debt will undoubtedly lead to further weakening of economic growth. And that's been the case for a while. We did have quantitative easing after the financial crisis in 2008, and you can see now by the chart on the left that this is the percentage of public debt to GDP. And we are now beyond 100% and have been for a while beyond 100% of GDP with respect to our total public debt. What's more important, if you look at this, the federal debt and the interest expense, you can see now that we're at the end of last year, $22 trillion of outstanding debt in our country. And the interest expense, in order to service that debt, the interest expense you can see has gone up and gone up and gone up. We're in a pretty low interest rate environment right now, and that's why the interest expense, even though from last 10 years, from 2010 to 2020, you've seen a doubling of the total outstanding debt, but you haven't had a doubling of the interest expense, and that's because interest rates have remained very low. So I think there's certainly an incentive for the Federal Reserve and for the government to keep interest rates low because we can't afford to have higher rates. We could not afford to service our debt at much higher rates. And you can see here is a graph of the 10-year U.S. Treasury yield. Even in a very short period of time, we've come down pretty precipitously down the curve where the debt on the interest rate on the 10-year yield is only yielding about 0.59%. And finally, I believe there's some other macroeconomic considerations that are worth mentioning today. The first of those is the implications of the recent coronavirus stimulus. We've seen the passing of the $2 trillion CARES Act, which has certainly helped to boost the economy in the near term, although I think there'll be longer term implications for the debt that we're incurring. There's also current consideration for additional stimulus. They're speaking about that today. That includes stimulus with respect to healthcare and hospitals, state revenue shortfalls, and extended unemployment benefits. And I believe there's also the possibility for additional infrastructure bill. So I think there's a lot of spending which is helping the economy, but I think there'll be some long-term problems with that as we accumulate massive amounts of debt. In terms of the upcoming presidential election, the election outcome and the implications of the election outcomes are not yet priced into the market, either the equity markets or the bond market. Biden victory, especially with a Democratic sweep of Congress, would likely result in a material shift in policy. One of those shifts in policy would be the potential for a $3 trillion new green energy initiative and infrastructure deal. That would certainly help alternative energy companies, and it would be difficult for some of the traditional fossil fuel and fracking businesses if they were to pass something in terms of the new Green Deal. We also could expect to see some tax rate changes, a different regulatory environment, and I think that would have some implications for the future of the U.S. economy as well. One question we ask ourselves is globalization over? We saw a 50-year time period where countries around the world increased globalization. We outsourced jobs, we outsourced supply chains. It made our products cheaper and helped growth in our country. But I think after the COVID crisis, we're seeing maybe a return to bringing some of those supply chains and the manufacturing back to the U.S. The OECD estimates that world trade volumes will contract by about 15% this year alone. It would probably be more in 2021. And that the pandemic fallout will likely impact international supply lines and domestic manufacturing, which is something to watch in terms of corporate security selection. So companies that operate here in the U.S., as they bring manufacturing and jobs back here, supply chains back to the U.S., there could be companies that benefit from that. Certainly the economy would benefit from that as well. The other thing to mention is demographics and a shifting population. Changes in demographics have been going on for quite some time, where we've had an aging population of baby boomers that are continuing to age and get older. They are typically not spenders in the economy. They're not making huge contributions by accumulating a lot of goods and services. They tend to be savers and living off fixed incomes. They also are taking out of Social Security in great numbers without having younger people that contribute to it. That population is declining. In addition to that, the birth rate in the U.S. continues to decline, so we're seeing a lot fewer people and depopulation of the U.S. as we have seen in previous decades. And also we've seen the savings rate increase. So when people got their checks from COVID and their PPP money, we're starting to see individuals and companies increase their savings rate. And we think that that's very different from what we've seen in the past, where U.S.s tend to be over leveraged and big spenders, which is a huge component of GDP, the consumer spending. So those are just some of the things that we're considering and thinking about how we look at fixed income markets and our strategy about managing bonds going forward. I want to thank you for listening today. I hope this presentation led to a further understanding of bonds and the fixed income markets. We really appreciate your time, and I want to thank you again.